Yeah. Yeah, and we were, kind of deep into the conversation, and you used a really great example of Costco. And so I think maybe we can kind of bring that in because they have a really interesting cash management philosophy, that I had not seen before, right? At least not in the way that you broke it down. So that was really fascinating. But, I I think that, I had a thought. Um, Sorry, I lost my train of thought, which happens sometimes on the podcast in real time, and we don't edit it. So we're just
It's
gonna
all
go
good.
with it. Um, we were deep into the conversation last month when you were doing the education, and you brought up the point, even though cash is important in the business and understanding how capital flows through the business, it is not the same as looking at your bank balance and deciding how to run your business.
Right.
So talk a little bit about that.
Yeah, I think, again, getting back to your original definition, current assets are anything that will be turned into cash within a year, including cash.
Yeah.
So you think about some of your businesses: inventory, receivables, some of the short-term receivables, and then on the payable side are things that you need to pay within a year. Think interest payments, current portion of long-term debt, payables that you may have, maybe accrued vacation, things like that. Uh, and I love using Costco as an example because they have built a whole business model in my mind around working capital.
Yeah.
And a lot of folks think they're a, warehouse, they're selling things, that they're a retailer. I think in a lot of ways they're a bank. You look at their profitability from last year, and about 12% of their net income came from interest income that they were earning on their cash. And that just is exponential now that rates are higher.
Yep.
But even when rates were lower, they were still earning a boatload of money on their cash. And not only that, they weren't having to borrow, so they weren't having to they were able to open warehouses and open new markets with their existing cash. So that doesn't show up in the income statement other than avoided interest expense.
Right.
So I think you really need to be thinking about what is being converted into cash within a year. I sit on a nonprofit board as well too, and we were growing at a 15 to 20% rate, but our receivables kept becoming more and more inefficient, and we quickly got into a cash crunch. So yeah, to get back to, I think Costco's a fascinating one just because I think they do it to the extreme. But you think about how they handle their inventory.